Today, we are taking a look behind the curtain. We are answering the number one question that people generally walk in the door with, which is what, GC?
Can I see inventory?
Can I see the inventory? Show me the money in the houses. That's what GC is going to show you today. It is a live demo of how you look at the inventory and actually build a portfolio efficiently, intelligently, and in a very not your average way. Welcome, everybody, to the weekly edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me, as always, a man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flow, is a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Fantastic to be with you all today.
Fantastic to be here today as well, GC. All right, GC. Let's just get right to it, man. I feel like we always get this question. Show me inventory. You, as someone, really where this started was you've always wanted to be in the Excel Olympics and be shown as an Excel athlete. And you've been begging me, Pablo, we always talk about, we've got these 3 calls and all this stuff before you look at properties. But what I really want to show everybody is how good I am at manipulating an Excel sheet. So here we are. We're going to show them the baby.
A boy can dream. Some people dream of being Michael Jordan or Tiger Woods. I dream to be on the Excel Olympics. By the way, they do have this on ESPN, the Ocho. I was sitting there on Sunday and I texted Pablo a video of, the person that I dreamed to be, and he was winning the grand championship of Excel. Yeah. So this is the best that I could do, but I'm really excited to be here with you all today going over this topic. It's one that I'm sure is on all of your minds or has been on your mind, especially if you're a newer investor. It's a tough decision to jump in and buy rental properties, and it's a notable, a worthwhile, a very normal question to say, hey, can I see the inventory? And how do you go about recommending properties for me? Help it me make sense in my own mind. And, as a turnkey provider, when you go and you ask, can I see the inventory? What you're going to hear many times is that we don't have a list. And that's a very truthful statement because as a turnkey provider, inventory changes hands all the time. And so it really doesn't make sense for us to keep a list that we would like on the website that we would update on a daily basis. And what it also does is it's not something that helps us make the right decisions anyways, because we need to have multiple conversations with clients. So JWB is not an outfit where you just go out and, put an offer in and buy a property. So anyways, so you see that a lot. Well, over the years, my team and I came up with an opportunity to be able to address your burning question of seeing the inventory in a way that includes you as the client in the decision-making process. And that's what I'm going to share with you all today. We get to go down a journey as if you're a brand new client. You've spent multiple hours on the phone with JWB so we can understand your goals, your resources. You've been vetting us for a couple of hours and a couple of phone conversations now, and we're going to fast forward right to property selection today.
Let's fast forward. You see, it is time.
All right.
Why don't you start pulling up while I introduce you, like if you're in the Excel Olympics?
Oh yeah, could you do that?
From Pittsburgh, Pennsylvania, standing at 6'4", 225 pounds, 3% body fat, all muscle. The greatest Excel athlete.
The Tayshaun Prince of the Excel Olympics.
Sneaky long and unbelievably athletic. He's been called the Tony Romo of real estate investing. Gregg Cohen.
That was really good.
Gregg Cohen.
Really good. I feel like I need the Matador or some type of name as well. You can work on that one.
The Matador.
All right, guys. So this is what portfolio selection and recommendation looks like within JWB here. So I'm going to walk you through, guys. Guess what? For all of you who are tuning in live on the Zoom, I'm so glad you're here. You guys are in for a treat because we're going to see lots of numbers, and I would love for this to be interactive. If you have questions about why did I choose this asset here? Or what would happen if we did this? Or how would you build my portfolio if I came in with this certain amount of money? Or what would you do? This is a great hour for us to dive into that. And for those of you who are on the podcast, it's a lot of numbers that we're not going to be able to read off the screen. So join the Zoom next time.
Yeah. If you're on the podcast, this is one of those where you're going to want to go to YouTube and look at this episode on YouTube so you can watch, you can follow along.
There you go. So
Drew says that the Tony Romo comparison is dated. Full disclosure here. Tony Romo, when we started the show in early 2020, Tony Romo was like new in the broadcast booth, and he was like really, really good, and he's also sneakily athletic and devilishly handsome. So that's why we use the Gregg Cohen comparison. Can't compare you to Brady because he's not that good in the booth.
That's exactly right. That's the only reason you can't compare me to Brady.
The only reason I don't see.
Oh man. All right, guys. So here's this portfolio generator that you would be able to see if, of course, as you're getting into property selection here. This first tab, I'm going to kind of breeze through it. I just want you to see it, but this is what drives all of the portfolio recommendations. This is where every asset that JWB has, we have 14 assets in inventory right now. You'll get to see all of those numbers right here. You get to see all of the important information that's going to drive your pro forma as well. So you'll see, you know, information on purchase price, percentage down, interest rate for your loan. You'll see a lot of information that is important to know today, like what is the monthly rent that is being earned right now, is being received right now. That's an important day one. I need to know that today. Other things like property taxes, insurance, those are important for today to know.
Mortgage rate.
Real
mortgage rate.
There you go. Your interest rate on your mortgage, right?
Yeah.
But you also need to be set up for success for the future. So there's other things on here that are assumptions that are based on our real world experience. Things like maintenance cost, vacancy cost, rent price appreciation for your market, home price appreciation for the Jacksonville market. And if you were doing this on your own, it'd be on your market. These are all really important assumptions that need to be based on something other than what did somebody Google or what is some industry standard. Again, all of this data is backed by a ton of research, both internal data and then data that we pay a hefty amount to our consultants in order to be able to have accurate data here.
Got it. So 3 buckets of stats here. They're kind of like the ones that like you can't get wrong, right? Like the actual stats on the house. Then there is the things that you need to know currently that you can get a quote on, like your mortgage rate and your insurance cost and things of the sort. And then there's the performance proprietary data that JWB brings to the table based on these like 6,000 data points and 19 years of history of how you make things perform that feed the estimate of returns, not just for year 1, but for year 10 through 100.
There you go.
All right.
There you go. All right. So now we're going to go to the next tab, which is your recommended portfolio tab. I'm going to break this down as well. We'll start with just kind of an explanation of what we're seeing here. So these top sections are here to make it really clear and easy as to what we're doing for you when we're making these recommendations. So your top box here, this client information box, is built for you. Of course, this is a live demo. But for this demo, what we're assuming, you know what? I wanted to start off with a little bit of a different budget there. You guys are going to see the next iteration of this in a second. But let's start off with a portfolio that is going to be held on for 10 years and that the client has $75,000 that they would like to invest in single-family rental properties with JWB. Down here, we're going to see your portfolio investment summary. And I haven't chosen your asset yet. You guys are going to be a part of that decision and that recommendation together. But I just filled this out just so you would see how this summary works. This summary, at the end of the day, guys, we love to be a steward of your money. We love for you to have trust in us, give us your money, and then we give a whole bunch back to you. And it's really helpful for you to understand how much we're expected to give back to you right off the bat. That's what this box, this investment summary, tells us. It says, okay, I've got one asset in this fictitious example. There's a binder deposit that would be required. We'll fill that out later. But this investment would require, call it $79,000 as a total initial investment. And then over 10 years, it is going to grow to the tune of about $116,000, which would mean that your total portfolio value at the end of 10 years would be roughly $195,000. Right? We are taking this asset, we put 79 into, and it's going to be worth 195 after 10 years.
Got it.
And then the real way to understand how hard your money is working for you is your internal rate of return. There are a number of different ways to look at assumptions and returns on investment and all this good stuff. Internal rate of return is the one you want to look at when making a decision on an asset like a single family rental property. It takes into account the cash flows, the timing of the cash flows, the amount of the cash flows. And so it's not just enough to look at the total value it will be worth. You need to look at how hard your money is working for you. And that internal rate of return number is a great way to standardize it, depending on when the cash flows come in. And we want that number to be very high, and it is, right? So 9.9% here.
Beautiful.
Then we want to know, how is this being driven as well, right? Is this a speculative asset that is all based on one profit center that is maybe costing you money every single month? Or is this an asset that is driving it over 5 profit centers? Well, in single family rental properties, it's over those 5 beautiful profit centers, and they all work so well together. And so we outline the portfolio and show you how much of your returns is going to be driven by net rental income, would be the first profit center, your tax savings, your principal pay down, your home price appreciation. And then we also include some knowledge about inflation hedging and inflation profiting, although to be quite honest, we don't include those calculations in our returns. The reason is it becomes a little theoretical, and the returns are strong even without including the inflation hedging and inflation profiting into it.
Got it. So this is, again, the 4 out of the 5 profit centers, net rental income, tax saving, principal pay downs, and home price appreciation.
There you go.
Got it.
We also include the costs that come along with this. Sometimes from the community, we'll hear questions, hey, does this include what it's going to cost me to sell the asset after 10 years or 20 years or however your hold period is? And the answer is yes. And this is available for you to see even before you make your investment decision, which is nice. This is something on that top 10 list of things that turnkey providers forget to include when they're giving you these fantastic 20, 30, 40% estimated returns on investment. I don't know another one that I've seen that includes estimated acquisition and liquidation costs. We, of course, take that into account, and that's factored into your return on investment.
Awesome. Okay. So this is a sample output of putting one property into the portfolio based on the inputs from the other sheets. What's next? Are we now going to figure out how do we actually pick a property here?
Yeah. All right. Now we're going to get into property selection together. Okay. So put yourselves in the chair of saying, listen, I've got $75,000 to invest with JWB. Let's say that you've done your due diligence on us. We've done our due diligence on you. We understand the goals and the resources. And now we're fast forwarding to the fun part, which is property selection. So
that's fun.
It is fun, right?
Yeah.
I mean, think of how hard it would have taken generally to get to the place that we're at right now, right? To understand, first of all, to find 14 assets that you were thinking about investing in, right? Then to have all that information provided for you, not just the information today, like rents and property taxes, but how much is that going to cost 5 years from now, 10 years from now? Yeah. All this is just packaged. So I think it's a lot of fun. What do you think?
Yeah, I hadn't even thought about it when we were talking about this, right? But generally the usual experience is you're trying to find a property and looking at 14 of them is probably not the norm, right? You're probably just looking at, does this one deal work? Does this one deal pencil? The idea that you can be looking at the grocery store shelf and be all right, which one of these do I want to put in my cart and check out with, feels like a very different.
Very different. Yeah. And if you're going through this experience with JWB, we also want to make this something that doesn't lead to paralysis by analysis. So a lot of what I'm doing with you on the call today would actually be done behind the scenes in preparation for your property recommendation call. Yeah. And then of course we walk you through how we got there. But yeah, so you've got the full grocery store aisle. You can pick and choose your 14 assets. And this just wasn't possible. It wasn't possible 5 years ago, even with JWB clients, to have this level of transparency. And definitely not when I started to invest 20 years ago.
Okay, shopping.
So now, because I want to show you everything behind the scenes, I'm gonna show you what I would do or what my team would do to prepare for your call in advance. And so what we would do is we'd look at all of the assets together before we make our property recommendation. So it's just really simple. We can just add which asset we want to add to your recommended portfolio just by putting a number here and adding it to the list here. So let's assume that we added all of these assets, even though I know that we're not going to choose 14 assets on our call today. And this just comes over to this next tab, which fills out your recommended portfolio. Now, why this is important is because now we can understand what our criteria is for property recommendation for you. And the way that we go from 14 assets and paralysis by analysis to understanding what is the number one right asset for you is simple. We go with our order of priorities. And our order of priorities is number 1, we're looking for the highest return on investment. Number 2, we're looking for positive cash flow. And number 3, it needs to fit in the budget. So we're going to look number 1, highest return on investment. Number 2, positive cash flow. And number 3, fits in the budget.
Okay. So ROI, return on investment. Number 2 is positive cash flow, making sure that it's not negative. And then number 3 is budget.
There you go.
Is there a reason why it isn't budget first?
Well, if you just go with your budget first, you might miss the highest return property.
Okay.
Right? If you only look at the lowest properties here, because listen, we need to drop it from 14 properties we're looking at to, a lower number of properties. If you just go with the lowest budget properties, you might miss the highest return ones.
Okay.
And it comes back to like, what is my job? What is JWB's job here? We are financial engineers. We are here to help you earn the best risk-adjusted return for your given budget.
Yeah.
It's not help you spend your budget and then get the best return with it. We are here to deliver the best risk-adjusted return first within a given budget. So
that makes me think that you're not just like, it's kind of how we talk about like the initial cost versus life cycle cost type of stuff that we've talked about in the past. I don't want to confuse it because I feel like that gets confusing.
Right.
But it's basically just not like you're not buying the cheapest property, you're buying the best value, right? That's what you're going for.
Yeah, absolutely. If you come to us with $75,000 and we find an asset that only requires $67,000 out of pocket, we're going to recommend that one rather than maximizing the $75,000 that
If
you
you're
came.
going price first.
Yeah, if you came price first and you said, I want to spend all 75, it would lead to an incorrect conclusion if our job is to deliver the best risk-adjusted return.
Cool. All right, let's see it. Let's see this ROI, cash flow, budget.
There we go.
framework. Let's see it.
So here's how we do it. We choose the property together and call it in less than 5 minutes. Put me on the clock here. All right. So we're taking this decision and we're going to make it a whole lot easier. The first thing we do is we look at what is our highest return on investment. So let's choose the top 5. We're going to go from 14 to 5. We're going to choose the top 5 highest return on investment properties. So we've got a 10.9 right here. Remember this, okay?
Rio Grande.
We've got Roselle. All right. We've got 3rd Street here.
Okay.
And Rio Grande, Roselle, 3rd Street. Then we've got Cocoa.
Yeah.
And then we've got these 2 on Caroline's Court, which is the same.
Okay.
All right. So we're going to do 6.
Oh, okay. That's spicy.
We're going to do 6.
Yeah.
All right. So now we're just going to come over here. We're going to limit the 14 and we're going to choose those ones. Do you remember them by heart?
Yep. I got it. We got 3rd Street.
All right.
We got the 2 on Caroline's Court.
Okay.
We got Cocoa.
Okay.
We got the Rio Grande
Oh, love that.
and Roselle.
There we go. All right. Now we're in line with how we need to make decisions as educated, not your average investors. We are here to produce a risk-adjusted return, the best one we can find. So we're going to start with what is the best return. And here's what we've got. So now we've accomplished number 1. Now the second step is positive cash flow. And we need to have positive cash flow both in year 1 and through the horizon. And this over here helps us understand on an individual property basis, how are those 5 profit centers working? If you remember up top where I showed you, it was from a total portfolio perspective. Now this is on an individual asset basis. So now this really helps us make sure that each asset is going to hit that criteria.
Got it. So if I'm following along this criteria, I'm just going to kind of guess here. We just went ROI. Now, next we look at rental income, net rental income to make sure that it's positive cash flow. And as I'm looking at this spreadsheet over here on R, they're all positive.
There you go.
So then what's the next step?
Well, so because we know they're all positive, the value of working with the financial engineer starts to show itself here. Because I don't look at that and say, geez, these are all positive. Okay, check, let's go on to the next thing. I'm looking and I'm saying, how can I drive a better risk-adjusted return for you, given those constraints, those 3 constraints? So I look at this and I see all of them are cash flow positive over the full horizon. Immediately my head says, how much have we put down? Because I know if I put less down, I'm going to drive a higher rate of return for you. What I'm going to do is actually see the net rental income come down here. And I'm going to say, if it comes down, but it's still positive and this rate of return goes up, is that a better thing for you? Absolutely.
Yep.
So now that we see this and we see that all 6 of these we come back to this sheet, and this is kind of what team's doing.
Time out. We're also looking at this idea of like total investment right now are all above 75,000, right? So we would have to go back and do some financial engineering if it's going to fit.
And this is the work that's done behind the scenes.
Okay.
So, but yes, if you saw this and you were just looking at this, you're like, well, nothing fits for 75. That would be another trigger and another clue to say, maybe we should extend it beyond the top 6. Okay. Maybe we would do it beyond, look at the top 8 or 9 to find the right one.
Got it.
Give it in the budget.
Okay.
So yeah, so we see that this is all positive, and we also see that budget might be a constraint, and we're saying to ourselves, all right, well, let's go back and let's see what the cash flow positive nature is, if we drop it from 30% down, which is what it's built at in the beginning, and we say now it's 25% down. Now we see all of these returns on investment have jumped up. Now we have a couple in the 11% range. And we're looking over here and we're saying, you know what? These are all still positive for the full horizon. Now we just financially engineered this to deliver a better risk-adjusted return on investment, and we lowered your investment out of pocket.
Yeah.
Went all around the board, right?
Yeah. And now that Rio Grande property is looking juicy.
There you go. There you go. So now we've got that, right?
Yeah.
We then are starting to say, okay, out of here, which ones have the highest rate of return? You've already zeroed in on Rio Grande. It's a clear, it's a winner here because not only does it have the highest rate of return, it also is within the budget of $75,000. So it just happens that this is a clear winner, and this is how we would choose that asset for you if you came to us with $75,000 today.
Very cool.
So it's not always that easy as a clear winner. What happens a lot of times is we are going back and forth between 30% down, 25% down, and we're choosing between some that are higher returns but may not be within the budget, which we share with the client and say, listen, this is your total out of pocket, right? Here's where your budget is. And we're looking at all three of these factors together to make the right choice. This one happens to be super simple. Rio Grande's the winner. That's the one that we would choose for you for $75,000.
Okay. Would we also go back and see if any of these work at 20%?
We could do that too.
Okay.
We would definitely do that prior to coming onto the call with you. And so that's really simple. I just see like the ease of this.
This is
like,
super easy.
Super easy, right? And you see how we're thinking the entire time. So I did the work before this call, so I knew that all of these were going to be cash flow negative, which is why I didn't take us down to 20%. But I'm really glad you asked.
Yeah.
Right? We, prior to getting on the call with you, would say, listen, we're going to do the due diligence, and we would make a recommendation. But here you can see all of these have higher rates of return, but they're cash flow negative over 10 years, you know?
Yep.
And you might say, listen, this one's only cash flow negative $270, but cash flow positive matters, especially if you are a brand new client, right? So what you're not seeing in this example, in this case study of going through this together, are the really hours of conversations we had to make sure not only do you have the right amount of capital to bring down, but are you set up correctly for reserves? Are you emotionally ready to handle the fact that there will be some cash flow swings along the way? You know, so especially for a brand new client, we're going to, stay at cash flow positive on their first asset. It's just a nice rule of thumb to follow. As we have more advanced relationships and deeper relationships with clients, and they have more passive income coming in over the years, we might explore a cash flow negative property over a 10-year horizon. But if and only if the returns justify it, and of course, if they're set up for reserves.
Got it. Correct me if I'm wrong, but the scenario in which you would explore putting in a cash flow negative property is if you already have, like, you're looking at somebody's passive income pie, all of it, and the passive income is going to be able to like supersede the cash flow negative from the property in a way that the overall thing isn't going to be cash flow negative, and therefore it might justify this rate of return because it's paying for itself within the closed passive income ecosystem.
Yes, what you said there is accurate, and I'm going to show you an example of this a little bit later.
Okay,
yeah,
because I was confusing myself even when I was talking.
Yeah, so
couple of comments here. Sorry, were you going to say something?
Oh, nothing. Go ahead.
You sure?
Yeah.
Okay, great. Because
I'm gonna address it later.
Venetia Valsamakis, great. I'm assuming that's a Greek last name, Valsamakis.
Love that.
Pretty good, pretty good. Venetia saying this is super helpful as I'm reviewing properties right now for my first purchase with JWB. Excellent, Venetia. And another V, Varinder Kumar is asking, does net rental income positive on first year after paying mortgage, insurance, and property taxes, etc.?
Yes, I'm so glad that you asked that question. When I say cash flow positive, they need to be cash flow positive first year and the year over the horizon, meaning 10 years if you're planning to hold for a 10-year hold. And it's really simple to understand that all JWB assets are cash flow positive in their first year, especially right now with the incentives that we're offering. So every property comes with a $4,000 to $6,000 JWB maintenance credit, which is what you receive day one. Well, it's actually in your first month of ownership, ensuring a cash flow positive nature, not just for the first year, but it really takes care of your maintenance and your vacancy costs over the first 5 years.
Okay.
So I have kind of sped ahead a little bit here, but all assets are cash flow positive in the first year. And so for us, when we're looking here for your net rental income, this is really just ensuring that over the full 10 years, given the amount down that we recommend putting down, are we still going to maintain a cash flow positive nature?
Got it. The ringmaster is asking, where do you see first year cash flow? Is first year cash flow on this spreadsheet, or are you already just controlling for that?
It's in a different spreadsheet that it's over here in all properties, but you guys can see this is a crazy spreadsheet here. So I thought we would not go into that one. But for anybody who is curious and how we can show you how that is cash flow positive, just reach out and the team will walk you through that spreadsheet as well.
Sounds good. Patron Centaurus, Michael Centaurus says, Greg, I noticed on the all properties tab, different percents in the maintenance, 4% and 7.5%, and vacancy, 3% and 4% section. Why the difference?
Yeah, that's such an astute observation.
Dude was the word I was thinking also, Greg.
So in sync.
So astutely in sync.
So you can see here, we've got estimated expected maintenance percentage of 4% on this asset and 7.5% on this asset. You can see it kind of will be either one of those two. And then vacancy percentage is 3% for some and 4% for others. Can you give a guess as to why that would be, Mr. Pablo?
My astute guess would be that the properties with 4% maintenance percentage and 3% vacancy are new construction, while the ones with 7.5 and 4% are remodeled properties.
There you go. And you see that right here in the year built. So the data shows that you're going to see less maintenance costs on a percentage basis for new construction homes and newer construction homes than if it's a home that is older but completely renovated. So it's not a huge difference, but it should make sense to you. If you have a brand new home, things are going to break less than if it's a home that was professionally renovated but might be 50 or 60 years old there. So that's the reason for the difference for both maintenance and for vacancy costs too, right? There's a little bit more of an appeal for a brand new home in a neighborhood that largely does not have other brand new homes. And so vacancy costs have shown to be slightly lower for new construction homes than they are for renovated homes.
Got it. Greg, I think right now it's time for me to come clean. I think I failed the show. I did not time you on the 5 minutes.
I know.
But I can tell you this. It feels like we have just kind of like what Denny's saying. Can you imagine taking care of all this yourself when purchasing multiple properties, from selection to negotiation to refurb to vetting renters to everything in between? JWB makes it easy. I guess the takeaway here for me is we've just analyzed 14 different properties. We've been able to pick one that fits the portfolio based on the ROI to cash flow to budget filter. And we're only 30 minutes total into the show, when quite frankly, normally we'll start a show and like we'll be 30 minutes in and we just finished the roll call.
I know, right?
So I don't know if it was 5 minutes, but it feels really, really fast to have like gone through this so quickly and be able to analyze all this type of stuff when normally you're having to do like, a million different steps in this if you're doing this yourself.
There you are. You want to take a look at the property that we selected here? Let's see if I
Let's take a look-see.
Let's see if I can pull this up here.
Pull it up. Oh, okay.
I don't know.
No, that's not.
Oh, you know what? I got it. Don't worry about me. Listen, I'm an Excel wizard. Okay, I'm in
wizard, but
in
you're
the
not
Olympics.
Zoom wizard.
I'm the Tom Brady of Excel sports. Okay.
Okay.
Oh, ye of little faith. Let's see if I can actually pull this off.
You're gonna have to stop sharing.
I know what I have to do. I'm an Excel wizard.
Great. You're on Zoom. You're not on Excel right now.
Darn. How about this though? How about them apples? Okay.
There it is.
So this is
which is the Rio Grande. This is Bill Shields' favorite property.
There you go.
Yeah.
This is the Rio Grande property right here. And so we have these virtual tours that are available, and you can see what the street looks like and all this good stuff. You can take a little tour inside. Let's go check out the living room. Why not, right?
Oh, okay.
Of course, this is one of JWB's new builds. Very common floor plan for us. We can take a look at the kitchen. Common question is, well, I see that it doesn't have appliances. Are there going to be appliances included? And the answer is absolutely yes. We get the pictures done and move somebody in the home, and then we drop the appliances just so they don't have a way of walking off, which happens when you build 400 homes, and people understand that. So you can take a little tour. You can go and see the you can go and see the rooms, the hallway, all this good stuff.
Let me ask something. Did you see this tour? I can't help but notice that tour of the home wasn't in your decision-making criteria.
That's right.
Tell me more about that.
Well, listen, these are assets. These are assets that are here to produce a risk-adjusted return on investment. So you have to separate the emotions of the home that you own. You have to separate the emotions of thinking of yourself as your potential renter, because often you are not your potential renter. You live, call it thousands of miles away. You may or may not have ever been to Jacksonville, which is okay, right? You make decisions to invest in things all the time that are a different part of the country. But for some reason, in those other assets that you make decisions to invest in a company or a stock or a bond, it seems okay for you to say, you know what, I am not that company, right? I am not that company's client, right? Well, in homes, we have this inkling that just because we live in a home, that we are the person that we're serving. And in this asset, you are here to provide a great rental asset for some other family to live in a different part of the country, most likely than you live in, who may or may not be you in terms of your desires and where you want to live in your neighborhood. And that's okay. So at the end of the day, we are here.
Just going to stop the share so people aren't just looking at a blank wall.
Oh,
While we're talking about this. Yeah, continue.
you love that, didn't you?
That was just freaking me out. I'm sorry.
Sorry. So at the end of the day, we're going to go into this property recommendation following that line of thinking. We are here to produce the best risk-adjusted return. We are not going to take a look at what are the color of the shutters, right? We're not going to take a look at what's the nearest shopping center. None of that stuff matters. None of that stuff matters. You have to make your decision based on the right team to support you, the right market. If you choose the right team and the right market, they will have all the information that matters about an asset, like I just shared with you. And then property selection can be enjoyable and fun and something where you are set up for success.
In these statistical analyses that y'all make, right? Like what I'm hearing, it's like, it's the numbers that really matter once you get to this call. Before this call, you're figuring out kind of like the whys and like, is this right for you? And are we a good fit for the experience and all this type of stuff? But Whitney Ritchie has a question here.
Oh,
she's asking the original flow from Progressive,
of course,
for the record. She's asking, how much do you consider number of bedrooms in overall analysis? Does the number of bedrooms affect kind of like those numbers that we talked about with maintenance and vacancy and stuff like that?
Yeah, we're pretty agnostic when it comes to the number of bedrooms. You know, 2-bedroom homes are okay. 5-bedroom homes are okay. The majority of the homes that we sell are 3 and 4 bedrooms, but that's just because that's the inventory that is most readily available in the neighborhoods that we are. But yes, 2-bedroom homes, 5-bedroom homes. You know, there are different folks that are suited more towards 2-bedroom homes, and there are different folks that are suited more towards 5-bedroom homes. So we don't pay a whole lot of, we don't have a whole lot of emotion towards one or the other. It comes down to the numbers. If there is a 2-bedroom home that has a better risk-adjusted return, we're going to recommend that one given your budget. And the same thing can be said for a 5-bedroom home and anything in between.
And risk-adjusted return, I'm assuming, is now defined as ROI, net cash flow positive, budget.
Well, risk-adjusted returns, I'm glad you asked because I say that a lot. Yeah. Risk-adjusted returns is actually a lot more than just what the return is. So, risk-adjusted return, everybody has a different level of risk. And I think when we go into those first few conversations and people say, well, why do you spend a couple of hours on the phone right off the bat? I'm listening, or my team is listening, not just for how much money do you have and what is your return on investment that you're choosing, but like, where do you currently have your money invested? Are you emotionally ready to handle an investment that may have some ebbs and flows, some swings to it? Yeah. There's a whole lot of consistency and reliability in this asset class, but one of the downsides is that, things break. And, you're providing housing for a family many times for 4 or 5 years, and sometimes things happen in life and there might be ebbs and flows. So, we're trying to understand not just what returns and what capital you have to bring to the table. It's a whole lot more of like, are you ready for this asset? What is your tolerance for risk? What type of risk do you really not have a tolerance for? What's going to keep you up late at night? Yeah. So there's a whole kind of like feels behind all of the investing, and we try to get all of the feels understood. What's going to keep you up late at night? All that understood before we get to the objective part. And now it sets the stage for us to be objective when we make these decisions.
Got it. Okay. So risk-adjusted return is numbers and data and like track record plus feels.
There's a little bit of feels, yeah.
There's a little bit of feels.
Yep.
Okay. Lee Bishop, the MVP, says, are these property evaluations, this thing that we're looking at, does this include the credits that are being offered right now? Do you see?
Yes.
Can you talk about the promotion that's happening right now?
Yes.
It's unprecedented. And is it included in this?
Absolutely. So we've run these numbers, including the incentive, because for everybody who can take advantage of it right now, everybody has the ability to take advantage of it right now. So the incentive is one where we are buying down the rate for you as a client to a very, very low level. Clients are actually locking in their rates in the low fives right now. Some clients have even been able to achieve a 5% interest rate. And the way that that's happening is JWB is buying down your rate for you. This is how we are ensuring positive cash flow year one. And it's a really, really big opportunity. When we rolled it out a couple of shows ago, it was for the first 30 contracts. And we have about 10 contracts remaining that it's available.
I was about to ask you about that. Okay, cool.
Yeah, it has been very, very, very exciting. And for those, I recognize many names who have already gone under contract to take advantage of the incentive. I won't say your name, but if you want to say it in the chat, go ahead and say it.
Lee said it in the chat.
Yeah,
he scooped up 3 himself.
There we go.
Yeah.
The MVP, doing MVP type thing. So we're so excited, especially for our folks in our community. Some of the folks who have taken advantage of this are our longest tenured clients, just real special parts of our Not Your Average Investor community. So it's really, really nice. I know you guys get the message more than most because you invest your time here. Yep. You get to chat with others and kind of bounce the message off of others. So really exciting. But overall, you get about $17,500 of incentives. This is the largest incentive package that JWB has offered. It's comprised of that rate buy down. And then JWB on top of that is continuing to give that JWB maintenance credit for you, which is equal to between roughly $4,000 to $6,000. And right after you close, within your first statement, we cut you a check for between $4,000 to $6,000, depending on the assets that you choose. And this goes to cover your first roughly 5 years of maintenance costs for you. Because we know maintenance costs are going to happen, we're going to go ahead and cut you that check. And so when you guys are asking, like, how do we know that it's year one, that they're positive cash flow? Those two things ensure extreme cash flow positive nature when you're walking into the investment.
Got it. I feel like this incentive has like all the pings of what gave me like the kick in the butt to start, right? Like I'm seeing like Lee's doubling in and getting 3. Wit's on this call talking about she already scheduled the call. She showed up in the group chat, and those are kind of like the people that, you know, when I first got into it, made me want to jump in and take advantage of an opportunity. So 10 properties left?
Yeah, about 10 contracts left. And then, you know,
how long ago did we announce this setup? Like 2 weeks ago?
Yeah, I think it was the 15th of May is when we announced it.
So 2 weeks ago, 12 days ago, we announced this thing. 20 properties have already flown off the shelf.
Yeah.
That's happening. 10 more left. Great opportunity to take advantage of that.
Great opportunity. And for those who are not current clients yet, this is a really special time because, as I mentioned, it does take a little bit of time to get to know you before we're going to go to property recommendations. So if you are interested, please text us right now and set up a phone call, especially if you're new, because I do want to make sure you can get that incentive, because once it gets to 30 contracts, guys, we are not going to do any more. This, like, as I mentioned, this is the largest incentive package we've ever offered. So I hope you get in. The text number, do you remember it?
No.
Gotcha.
I'm not a numbers guy.
Gotcha. 904-293-0341. Shoot us a text. We'll set up a phone call for you.
All right. And Lee shared his phone number in the chat if anybody wants to pick his brain about it. Not a JWB employee, just a JWB investor that happens to be very generous at this time. All right, GC, we've gone through your spreadsheet Olympics. We've gone through your mental scaffolding of how you pick a property for one property for somebody with $75,000 of the budget. What if I'm a big baller like Lee and I want to pick up 3 properties and I've got closer to like $250K of something that I want to put in, GC? How do we build a group of properties?
Glad you would ask.
Spreadsheet Olympics.
Glad you would ask. And if I was only a little bit more of an Excel wizard, I would have pulled it up by now with the screen share. But I've been put into my place, and
you're an Excel wizard, not a Zoom wizard. We know this.
Okay.
I'm the Zoom.
I don't know the difference between the two.
I'm the Zoom wizard.
All right, guys. So let's talk about how we would build a portfolio for a $250,000 investment. A client came to us. We came to understand that $250,000 is the right amount for them to invest. So I'm going to show you that. First thing, though, is let's talk about why is it important to get to 3 properties. When I see 250,000 for the client bringing it over, I immediately think, okay, great. We can start this client off. We have a really good chance of starting this client off with 3 assets. 3 is a really important number. And it's because, number one, I want you to last in this asset class. And one of the most important things for lasting in this asset class, being here for a full market cycle, is having an asset, having a portfolio that's diversified. You know, Pablo, you have 3 properties. Well, you have 3 properties. You have more than that, right? You live in the duplex, right? So as an owner of rental properties, is there really ever a time that there's not something going on with your rental property that might have maintenance or vacancy?
Yeah. I've actually been through a nice little.
Okay.
I feel like I've been through a nice.
Don't get too comfortable.
Year and a half, 2 years where like that hasn't happened, but there is also times where something is happening at one of my properties.
Yeah. You know, you start to get to 3, 4, 5 properties, and you've had a really nice run. So
I've had a nice run.
I love that. But at some point, you start to feel like, listen, there's always something little that's going on with my asset. You know, and then over time, one of your people, one of the families in your homes leaves, right? The end of their lease comes, there's a property turn, maybe there's a life situation. Something is always going to happen. And what you want is to get into a situation where you have other assets that are performing just like they should and actually overperforming at that time, because there is no maintenance and vacancy at that time, to be able to buffer or buoy the other asset. And this is going to become normal for you, for the clients who own multiple assets. You know, I'm sure you can chime in and say, listen, the reason that I don't get really bent out of shape when I have a property turn is because I have 7 other assets that are all producing a lot of positive cash flow. And it's just kind of like a carousel is the way I think about it with my own portfolio, right? And then it helps me just manage it based on numbers rather than emotion. So I want you to get to 3. If you have the opportunity to get to 3 right off the bat, we're going to definitely advise you to get there, because that seems to be just a nice starting point for where diversification really happens. Other things to consider: the incentives are usually bigger when you get to more properties at one time. So this incentive that I just shared with you is available for any number of purchases, but that's unique. Once this incentive is over, we typically have an incentive for buying 3 or more at one time. And so you can maximize incentives that way. And then you can also reduce your property management fees. It's called the JWB Elite program. So once you get to 5 assets in your portfolio, we drop your property management fees on every asset you have with us, every turnkey asset, from 10% down to 9%. And then when you get to 10 properties, we actually drop it down to 8% again. So all these things, when we see 250 or somewhere around there, we're saying to ourselves, okay, cool. How can we be able to financially engineer this in a way that we can get to 3 properties in that initial property recommendation for you?
Got it. Okay. So you got 250K. You're going to try to get to 3 properties or more.
We are.
Okay.
We are.
Let's do it.
Let's do it. So now for this one, you know, we've got all 14 assets, but here, you know, I really have to think about a lot of things when I'm going to financially engineer this portfolio. I need to think about how I'm going to adjust for not just return on investment, not just for budget, but there's going to be some combinations of assets where we might actually want to put in a negative cash flow property into the portfolio. So I wanted to so let's kind of talk about that for a second. Actually, let's talk about it.
That's what we just talked about, right? Like if you're already building in a portfolio, if you can build a portfolio where 2 of them are so cash flow positive that the third one can be cash flow negative, but the overall cash flow positive of it covers that cash flow negative, but you can still juice the returns. That's
what we do.
We're doing, right?
We should be happy to take on a cash flow negative property if and only if our overall return on investment is higher by doing that.
And within the passive bucket, your cash flow is covering that piece.
Exactly.
Right.
Exactly.
So your passive income bucket is cash flow positive beyond just the like single property cash flow negative.
Exactly.
Got it.
Exactly. So because of needing to kind of like see all of that, we're going to take a look at all 14 at one time, right? Just to make sure that we're looking at this together and that I'm not missing anything. It's not one where we want to just limit it to the top 5 or 6 because there's a little bit more financial engineering that's required here.
Okay.
All right. So we've got all 14 here again. We're going to come back and let's see.
Do we want to keep this at 25% down, or we want to go up to 30% down?
Well, you know, what I would do if we were starting this over and this was behind the scenes preparation for our call, I would put it at 30% first and then I would go down to 25%. But because we just went through that exercise and I saw that there were a lot of properties at 25% that were cash flow positive, I'm going to kind of give us a little cheat code here.
All right, Brady.
All right, there we go. said I was Romo, right? I can't be.
You are Romo
I'm not Brady.
of show hosting. You're Brady of Excel sheets.
But what was the
Don't
reason
worry
that
about it.
Brady?
Let's just keep going. Let's just
All
keep
right,
going.
here we go. All right. So here's what we're gonna do. We're gonna take a look at 25% down. We're gonna focus on our max rate of return. We're gonna take a look at our cash flows to make sure that they're positive, and we're all gonna make sure that this fits into $250,000 out of pocket. So, all right. So here's what we do. First thing I do is I run scenarios. So now I'm looking at what is the lowest out of pocket is one scenario. And what would my cash flow be and what would my rate of return be? Then what would be my highest cash flow scenario? So I'll choose a few properties because of that. And then what would my highest return on investment scenario be? Now, obviously, if my highest return on investment scenario also gets me to the budget, then we would, and the cash flow was positive, then we would do that.
Okay.
Doesn't typically work out that way. So what I'm trying to do now is to take it from 14 properties to limit it down to maybe like 6 or 7 or 9 or something like that.
Okay.
All right, so we're gonna go through a few scenarios. First thing we're gonna look at is lowest out of pocket. So here's where our initial investment is. And I've got one of these at 60,000. We've got one at 57,000. We've got one at 60,000 out of pocket. And we've got another one here at $69,000 out of pocket.
Am I taking notes on these names?
I put a couple of notes here, but yeah,
Okay.
we've got the property at 5th Street.
Mm-hmm.
We've got the property at Bridle Avenue, and we've got the property at Moncrief Dinsmore. Okay. So with those properties, right, I'm going to include this because I might need this budget to be able, this low budget to be able to put it into the 3 property portfolio.
Mm-hmm.
But when I'm looking at the cash flows at 25% down, they're not cash flow positive. If I was to put this portfolio together, my 10-year cash flows for this portfolio would be, what's that, -7? No, that would be -$16,000.
Okay. Not great.
Then we're not setting you up for success.
Yeah.
But the goal here is how do I limit it from 14 to get a lower number that I can kind of analyze through. So, all right, so we got those 3. Now let's go with the max cash flows. All right, so here we've got a couple of $6,000 properties, 5,000. Okay, cool. So now we've got 3rd Street, Cocoa, and Rio Grande. Those are the max cash flows with 25% down.
Okay.
So my initial investment here, let's see how much out of pocket. That was Rio Grande and that was Roselle. So my out of pocket here is $275,000.
Mm-hmm.
So again, not going to be the combination that we want. But now I say, okay, if I need to pull some cash flow to offset a negative cash flow in another portfolio, here, this is why I'm choosing those properties to put in the mix. And then lastly, we're looking for our highest return properties. So we've got Rio Grande here, we've got Roselle at 11%, and then we've got 3rd and Cocoa here. Now I'm going to try to limit it to 3 here, and I see that Cocoa has 90 grand out of pocket, but it has the same return on investment. This one on 3rd is 98 grand out of pocket. It's the same return on investment. Mm-hmm. So I'm just going to choose Cocoa because it has a lower out of pocket and it has the same ROI.
Okay.
So we've got Cocoa, Rio Grande, and Roselle to add to the list there. All right. So now we're going to take the 14 assets and we're going to drop it. We're going to just choose the ones that we just identified there. What do we got?
Rio, Cocoa, Roselle.
All right.
And then 5th Street,
okay,
Bridle, and Moncrief.
And Moncrief Dinsmore. Okay, cool. So does that make sense as to how, like the goal behind taking those scenarios?
Yeah.
Okay.
Yeah. You're basically going and picking for like the very top of returns and the very bottom of like down payment.
Yeah.
Right? Returns and cash flow and down payment.
Exactly. And I'm looking at cash flows as well because I know that that's the second most important criteria there, right? But the odds that we're going to find our best combination is very high that it's going to be within those scenarios. So, all right, so now we've got that. We've got these 6 properties to take a look at. Now we just start looking at this together and saying, okay, what's the best combination? So I'll start with returns. We see Rio Grande here, 72 out of pocket and positive net rental income. Really good chance. Now we know that Rio Grande was our property selection no matter what, or on the first one. But if we didn't know that, really good chance that we're going to include that in the portfolio because, you know, we've got on average about 80-ish grand out of pocket per asset in order to fit the $250,000 total out of pocket. So I'm looking at that and I'm saying, well, there's a really good chance there. I'm also looking at it and saying, you know what? I've got $7,000 of positive net rental income to play with here. right? Meaning I might need this to offset a negative in order to get to the 3 properties. Now I'm looking at Roselle. It's 11%, but it's got a significantly higher initial investment, $104,000 out of pocket. That's going to be pretty tough for me to put into this portfolio.
Yep.
It has high net rental income, but I'm looking at that and I'm saying, I don't know if that's going to work. And then we've got Cocoa here. We know from our previous scenarios that running all 3 of these will be too much of a budget. It's actually $200 out of pocket. Our budget's $250. So I know that that's not going to work. So now I'm going to start mixing and matching based on my order of priorities. Max return on investment, secondary is cash flow, and then third is budget.
Got it.
All make sense so far?
All makes sense.
Okay. So let's start to mix and match. All right, we've got Rio Grande here at 72. Let's see what Cocoa is at 90. And let's see if we could add the next highest return asset here. And we've got Fifth, right? So Fifth is $69,000 and it's the highest return on investment. So we have a sum of $231,000 out of pocket there.
Okay.
That's good.
Yep.
Right? Our max was 250. Now we're at 231.
Yep.
So we've also understood that this is the highest return combination that we can find as well, right?
Yep.
11.3, 11, and then 10.1. We are not able to include the Cocoa property because that one...
That would take us over the deposit.
That would take us over the deposit, right? Now let's start to take a look at what our net rental income is. So we've got positive net rental income on Rio Grande and Cocoa. I'm sorry. Yes, thank you. Rio Grande, Cocoa, and we've got negative on Fifth. But our total portfolio, positive cash flow.
Yeah, weren't we looking at Rio Grande and Roselle and then Fifth?
Yeah, what were we looking at? We're looking at Rio Grande,
Roselle, and Fifth.
Rio Grande, Roselle, and Fifth. Sorry. There we go. All right. Yes. So that one's actually at 246, right? We are under. But you know what? Now, I don't remember what we were just looking at, but I don't think that we can run the scenario here, but I don't think that that's going to get us our highest return on investment.
Okay.
Because, well, actually it would. You're right. There we go. Yeah, because we've got 11% here and 10.1. There we go.
I just followed your formula.
Yeah, you did.
Like I looked at the ROIs, 11.3 and 11.
There we go.
And then those are the 2 highest from the high down payment size.
Yep.
And then I looked at the 2 highest from the low down payment. I looked at the highest from the low down payment side, and then I went over to net rental income, and I just kind of like did some quick math and realized that close to $7,000 or 6,300 minus 3322 would make sense. And then I looked at the total investment, and I just added up 7,204, 68, and came out to like 230.
There you go.
Yeah.
Well, the sum is actually 246.
Well,
yeah,
this is just rough math.
Well, no, I'm saying you did it exactly right. So we're under the 250 threshold, and you can see now that we've got net rental income positive for the entire portfolio, right? So now we're positive about 10 grand for net rental income, and then so what we do here, we got Rio Grande, Roselle, and Fifth. Boom, 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 bing, bang, boom. Rio Grande, Roselle, and Fifth, and there we go. Now we've got a portfolio that has 246 out of pocket. Our overall rate of return is 10.9%. It's weighted for our entire portfolio. And now we've built a portfolio that's going to deliver positive cash flow over the full 10-year horizon. And we maximized our incentives. We got closer and closer to reducing our property management fees from 10% to 9%. We diversified. We did it all.
I love it. Greg, there's a challenger to your throne of the Super Bowl of Excel sheets.
Oh, yeah.
The ringmaster Drew Barnhill says, if you go back to the portfolio generator and you look at the top one, it's Hart Street.
Yes.
What happens if we switch out Hart Street and Fifth Street?
Okay.
So take Fifth out.
All right.
And put Hart.
Let's do it.
I forgot what the original.
So
this one also qualifies as under 250, and it still comes in at positive cash flow and provides a 10.9.
There you go. I think it's roughly the same numbers. So 10.9. We could run this scenario. So remember, 10.9, $10,464. Boom. This is the fun part. There we go. 10.9. And then the ringmaster found $400 of additional cash flow.
$400.
There you go.
There you go. Silver medal
Game
for
on.
you, Greg.
Hey, I'm happy to take the silver medal. That's why we're all a part of this together.
That's awesome. That's cool. All right. So, and that is how simple it is to visually look at it and come up with your own things and then punch it back and forth, right? Like I would assume that you're on this call with someone like Drew or someone like myself, right? Two completely opposite ends of the spectrums when it comes to numbers. And both of us were able to just kind of like deduce our own theories that were additive to whatever you were looking at in your theory. And then it becomes this dialogue that then produces an output that is quantifiable. And then you can make the right decision.
Game on.
Game on.
That's how we do it. So that's how you go from this really tough, here, I'll stop the screen share there.
Okay.
That's how you go from this really tough, just thing that you have a hard time getting over as far as like buying a rental property, going through the process. How do you trust the person on the other end to this? This took, 45 minutes of us kind of, going back and forth. We could have done this in probably 30 minutes.
Yeah.
And you would have felt really good and confident about how you were set up for success.
Yeah, what I see in this is taking something with many inputs and being able to like look at it from a standpoint of like we can agree on like one baseline, one source of truth of ways to examine it, and then also make it really interactive to make an easy decision, to make a hard decision easy.
Yeah, I mean, the hardest part is taking the first step and having confidence, really. And so this process allows you to have confidence. I think that's what we're all looking for, especially when we do something that requires a lot of courage, something that's outside of our comfort zone.
Yeah.
So this is available, and hopefully you guys take us up on it. If you'd like to have this done personally for you, just reach out to the team, send us a text, and yeah, just excited to share this more and more with all of you.
So what's the text number, GC?
904-293-0341.
Or go to chatwithjwb.com if you want to go through this process. Again, you would sit down, you first call if you're a new client, you'd find out kind of like what this experience is all about, make sure that you have the right expectations, figure out what your why is, then you start working with like the resources and what you're able to do, and then you get to this call, right?
Absolutely.
Yep. I love it. Venetia asks, in those models, Greg, reduced out of pocket to 25%, but will the approved lender using the current incentive still get us to those low 5% interest rates if not putting down 30%?
It depends on you. It depends. So it is possible to do that, but a lot of it depends on you and your ability to qualify. So we can get you that answer quickly, but just plan to be somewhere and call it the low fives is generally pretty doable depending on what your credit portfolio is like.
Got it. GC, your dream came true today. You became a TV Excel athlete. You're sweating, which shows the effort that you're putting into this.
I know.
See his face glistening?
Woo!
Notice how mine is not. I did not do any work. You're clearly an athlete out here, buddy.
Listen, I'm laying it all on the line.
Laying it on the line.
If anybody knows how to get an invite to the Vegas Excel Championships, Olympics, please put me in touch.
I think we need to figure out a guy's trip for that.
Yeah, I don't think that there's many guys trips for that.
So that being said, if you want this experience, you want to go through this, all you got to do is chat with jwb.com or shoot us a text or call JWB. Good job, man. You've been wanting to do this for a long time. I feel like you have been talking about it for a long time. How do you actually demo this property selection thing? Yeah, your team put together the spreadsheet. You showed it off. You showed your skills. I think it really took a complex problem and made it a simple kind of like choice, man. So I really liked it. I want to thank the community. We had around 80 people today for an hour watching you do your gift. Watching Excel theater over here.
Nothing better than just looking at some guy managing some spreadsheets, man.
And listen, at the end of the day, taking an hour of the middle of your workday to show up here, make this great, make Greg live out his dream of being an Excel athlete. I commend you for being here for the education, for the community, all the value that you add. We love seeing the community showing up, finding out more, taking advantage of this incentive. I think, am I allowed to share the massive spike in numbers from the community of like buying properties right now?
Yeah, go for it.
Yeah, 50%, more than 50%.
I think it was 48%, but I know last week there was a ton of community members that purchased.
Right around 50% of all properties being sold by JWB is to community members like you. So it just shows that coming to this show, being a part of this community, adding to it, you get more than you give, right? Because you get this insights, you get to make intelligent decisions during a hard time where it's like everything is scary and everything feels uncertain. So I really want to commend the community for taking this opportunity to like see through the noise, to not buy into the fear economy, make smart choices, use data plus perspective to put yourself in a great situation for your financial future. Next week, speaking of putting yourself in situations for your financial future, most folks, when they're thinking, I'm going to get a property. You might have enough for one property, but it might stop you if you don't know how to get to your third property. So we're talking about, you got one property. Now what? Right? It's this idea that if you have one, or if you're like thinking about getting one, but you don't know your path to three, you'd be surprised how quickly you get there based on 3 different scenarios that we're going to run of having no extra cash, a little bit of extra cash, and a bunch of extra cash, right? We're going to run 3 different scenarios. We're going to put old Mathlete here to the test to show us how that's done. And you're going to get this like perspective of like how quickly you can build your portfolio, because it's not about the extra cash that you have laying around. It's about the strategy, and it's about the team that can get you there. So see you all next week. GC, any piece of advice before we get out of here?
Don't be average. See ya.